This, I should mention, is joint work with Jacob Leshno, who's another colleague of mine in Decision Risk and Operations, and Gur Huberman, who is in the Finance Group. And as Melina was mentioning, one thing that I think, from my perspective, was quite nice about this is it's a piece of academic work that sort of cuts across at least two different areas. One is obviously finance and economics, but also, as we're going to see shortly, there's a whole bunch of operational issues and things about congestion and queuing, which are things that I'm interested in that come out. So what we're going to talk about today is the economics of Bitcoin. And before I start also, I should say I'm hoping this will be a little bit of a casual discussion. So please feel free to raise your hand if you have any questions or anything like that. Now, when I'm talking about the economics of Bitcoin, when we think about Bitcoin or more broadly cryptocurrencies, usually there's at least sort of two different functions there, right? Oftentimes, especially when you read, in the past 6 months about things like Bitcoin in the press, people are really thinking of Bitcoin as an asset. Something which has a price. The price has been going up recently. Why? Is it going to keep going up? Should we buy it? So on and so forth. That's one aspect. Bitcoin is indeed something you can buy. It's a speculative asset. But another aspect, and what I think is kind of a more fundamental underlying asset, is a payment system. Right? Bitcoin is a mechanism by which one person can pay another. Right? And this talk is going to be more focusing on the latter. How does Bitcoin work as a payment system? So in particular, I hope I'm not disappointing everyone, but I'm going to make no prognostications about what the future price of Bitcoin is going to be and so on. Right? But nevertheless, I think it's important to understand Bitcoin as a payment system because that's sort of the underlying fundamental value. Right? To the extent that you own a Bitcoin, aside from watch it hopefully appreciate in value, the only thing you can do with it is pay someone else. Right? So in order to, what I think is understanding Bitcoin as a payment system will indirectly also speak to its value as a speculative asset. But in any event, what we're going to do is we're going to look at Bitcoin as a mechanism for payment. Right? So in particular, there are a number of electronic payment systems, cryptocurrency-based electronic payment systems. Bitcoin is the first. This is a little bit of a dated slide. $1 billion is nothing in this space. There are many of them. Again, electronic payment systems are a mechanism for one person to pay another. More sophisticated systems are also being developed. Things you may have heard of like smart contracts and so on, which build upon that. And I think the interesting and really novel thing about this versus what was available in the past is that it's really a decentralized two-sided market. Right? When we contrast that to other sort of, let's say, legacy electronic payment systems, things like PayPal or sending a wire from your bank or using Venmo or something like that, Bitcoin provides a similar kind of service, but without any kind of company or central organization coordinating things. And this is really enabled by the idea of a blockchain, which is something we'll discuss shortly. So at some level, this is really kind of a novel economic structure, right? It's really owned by no one. It's a protocol, right? Anybody can participate either as a user making payments or as a service provider verifying other kinds of payments. And what we'd like to do is we'd like to explore this novel economic structure. So here's a list of other cryptocurrencies. Let's contrast them to traditional payment systems. Again, all payment systems at some level allow users to hold balances and make transfers. So maybe think of something like Venmo. Right, Venmo keeps track of how much money is in your account and provides a mechanism for one person to pay another. There is a controlling authority, in this case the company Venmo or its parent company PayPal or whoever owns it. Right, they're the ones who sort of provide trust. Right, when you use Venmo to sort of pay someone, at some level you are really relying on that corporation to sort of not take your money and make sure someone who's paying you actually has money and so on and so forth. And at some level, these are natural monopolies. right? The second you have kind of a payment system, there's network effects, right? The more people are on that payment system, the more useful that payment system is. And this kind of creates network externalities that sort of, typically create these kind of winner-take-all kinds of scenarios, create monopolies. And the bad thing about the monopoly is that gives the person operating the monopoly, the monopolist, it gives them a lot of power. Right? They can set the fees as they wish. They can extract monopoly rents, and they can get a lot of the surplus. And oftentimes, regulation enters to sort of mitigate that, monopoly power. And even in the absence of this issue of monopoly, in the traditional electronic payment systems, the idea of having legal recourse is very important. Right, again, going back to the Venmo example, at the end of the day, if you have a balance with Venmo, you deposit some money there, what's the guarantee at the end of the day that they're not going to take your money? Well, at some level, maybe you trust them, but at a deeper level, if they do, you will sue them. Right, and then we have laws in this country, and you're not allowed to sort of undo things like that. So at some level, there's an ultimate appeal to legal recourse. Right, now we're going to contrast that with these sort of decentralized cryptocurrency-based payment systems. So on the left here, I have a traditional payment system, something like let's say Venmo. You have a whole bunch of users using it. On the other hand, there's some computers at the back end who have to sort of keep track of things, databases that keep track of your balances and so on. And this is all kind of centralized. In other words, there's one person running it. They decide how many computers to buy. They decide what fees to set and so on. It's sort of a little bit of a monopoly setup, right? On the other hand, in the Bitcoin world, at the bottom here, you have the same kind of users also seeking to make and receive payments. However, who's keeping track of those payments? It's not some kind of central entity. Instead, it's these people over here. These are what are called miners. Right? These are decentralized infrastructure providers who are making sure that when payments are made via this system, that they sort of follow the rules. In other words, you don't spend money that is not yours. You don't spend money twice. So on and so forth. Whatever the rules of the system are. And this is kind of quite novel and different. And instead of, again, being intermediated by a single entity, there's a protocol that sits in the middle, a piece of software. So let's think about how this works. Again, centralized system. There's a firm that's running it. The rules are set by the firm. Right? The infrastructure. How many computers do we need to make sure that everything is fault tolerant? How do we ensure there's enough infrastructure so that hackers can't get there and so on? Again, set by the firm. The fees, right? How much revenue is generated? Set by the firm. And here's where we worry about things like monopoly pricing and monopoly rents. And the ultimate trust mechanism is legal recourse, right? In the Bitcoin world, on the other hand, the rules are fixed by a protocol. The infrastructure, it comes from these miners, right? And anyone can be a miner. You could be a miner with your laptop, right? It wouldn't be particularly a good idea, but you could. There's free entry and exit. So in other words, based on sort of how much money is being paid to the miners, the number of miners will self-equilibrate, right? Similarly, the revenue, how are the fees generated? Well, what we'll see is the fees are generated via an equilibrium congestion pricing outcome, right? In other words, people decide how much to pay, and they decide rather than a fixed price being set, and they basically decide how much to pay in order to avoid delays and have their transactions processed quickly. And how do we gain trust? Well, again, we don't have, we like to have a decentralized scheme that doesn't need sort of legal recourse. Here again, trust is also an equilibrium outcome. Right, trust here is sort of making sure about all these transactions are legitimate. That is checked by the miners. And as we'll see momentarily, as long as there are enough of these people independently checking all these transactions, we can be pretty sure that all those transactions are valid. Right, so this is something that's completely new and novel, and in some sense, kind of amazing. Right? And what we'd like to do is, at an economic level, try and understand how this operates. How are things like revenue and infrastructure and so on set, and compare that and contrast that to the classical model. So let me dive into a little bit more detail. So how does Bitcoin work? Well, let's start out with a transaction, right? A transaction is something that literally looks like this. This string of numbers here is an account number. That's the account that's sending the money. These are two accounts that are receiving the money, and there's some sort of numbers here, and there's a transaction fee here. Those account numbers aren't important to us. For us, we're going to abstract away the details of this transaction into something that looks like this. This transaction is saying that account X is saying sending out 9.5 Bitcoins. 3 of the Bitcoins are going to account Y, 16.4 are going to account Z, and 0.1 Bitcoin is offered as a fee. Right? So that's what a basic a Bitcoin transaction looks like. And there's more than this. There's sort of cryptographic stuff to sort of make sure that the person who wrote this transaction is the guy who owns that account and so on. But we're going to sort of put that aside. At the end of the day, the building blocks of Bitcoin and the blockchain are a series of these transactions where money flows from one account to another. And we're going to represent each transaction as a bar here. Yes?
Who is the fee paid to?
We'll come back to that. But that's an excellent question. Okay, what is the blockchain? The blockchain is simply a list of all past vetted transactions from time 0, from the so-called Genesis block, right? And all those transactions are taken, and they're organized into a series of blocks which add on to each other. Right, so here the first block has 4 transactions, the next block has 3, and so on, all the way up to the present date. That's what the blockchain is. It is basically a ledger. It is a list of all these transactions merely grouped into these separate blocks. And the idea of the blockchain, it is sufficient state to verify account balances. Right? A core function of a payment system is to prevent people from spending money they don't have. Right? So if I want to understand at an instant in time how many Bitcoin does Melina own, one way to do it is to go from the beginning of time, like look when the Bitcoin arrived to her account, look what Bitcoin she spent since then, and simply add up how much is left. Right? So this is one representation of a sufficient state that allows us, it gives us all the history, but the important part is in particular, it also gives us enough information to check new transactions. Right? To check that the people who are spending the money actually have the money. Now, how does this blockchain evolve? The idea is you have these so-called miners, these service providers. Anyone can be a miner. There's free entry. Again, all you need is a computer, a hard disk, and a network connection. Right? Each of these miners holds identical copies of this blockchain. Right? And therefore, each of these miners can truly be a service provider because they hold a ledger of all the past transactions. They have enough information to be able to vet future transactions. Right? So you have all these miners operating, and not 3 of them. There's millions in reality. And what happens is when someone wants to make a payment, that payment corresponds to one of these bars. That's a transaction. There's a pool. They transmit their transaction to the miners. That sits in a big pile of unprocessed transactions. This is what Bitcoin people call the mempool. These are transactions that nobody has checked yet. Right? So those are available to the miners. And what happens is roughly every 10 minutes, a random miner is picked, and that miner is allowed to assemble a block. Right? What that means is the miner takes a whole bunch of transactions that have not been vetted and processed, vets and makes sure those are legitimate transactions, organizes them into a block, and then adds them onto this chain and then transmits that chain to other people. Right? So that's how the system grows. And bear in mind, this is going to be critical. The block sizes are limited. Each new block can be at most 1 megabyte, at least historically. Now things have changed slightly, but for our purposes. And that corresponds to approximately 2,000 transactions. Right? So in particular, if there are more than 2,000 transactions here available, the miner will take up to 2,000, will check them, assemble them into the block, add it onto the block, and then those other transactions will wait for the next miner. They'll wait maybe 10 minutes longer. Right? So again, once the elected miner assembles the block, it transmits it to the others. And the others also, before accepting the block, they also verify that the transactions of this block are legitimate. Right? And so therein comes the security, right? The security in Bitcoin comes in because you have a pool of many, many, many miners, and they're all checking each other's work. And if one of these guys cheats, if let's say miner 2 cheats and allows someone to spend money that they don't have, these other miners will catch that and will not accept the block. And this is what a mine actually looks like. It's a dark place with a lot of computers. Right, so now why do people bother being in this mining business, right? Presumably they have better things to do than check the transactions of rather than other people. Well, they get paid for it, right? And there's 2 sources of payment. One is that if you're the guy who is elected to assemble the next block, you get a fixed amount of newly minted bitcoins. Currently, I believe it's 12.5 bitcoins. Right, so that's one mechanism. New bitcoins are created, and your reward for creating a block is you get to keep those bitcoins. So part of that block is your bank account gets those bitcoins, and that's about maybe 70% of the current reward. But the other part of the reward is the transaction fees, right? We have this question of who gets the transaction fees. Well, the miner that assembles the block that has your transaction, he gets to keep that transaction fee. Right, so right now, this is about 30% of the reward, but in the long run, all of the reward is supposed to shift to this. The original vision of Bitcoin was that there would be a finite number of coins, up to 21 million Bitcoins. So over time, the minting is going to sort of stop, and the system should be self-perpetuating in the long run based on transaction fees. Right?
Question.
Yes.
I thought that the miners were randomly selected, so how do they know that someone has put a higher transaction fee out there in order to incentivize it to move faster through the line?
Okay, so think that you're a miner, right? And you've been elected to assemble the next block, right? What transactions are you going to put into that block? You can put up to 2,000, right? Let's say there's 10,000 transactions sitting there. Well, you're going to pick the 2,000 with highest fees. Right, because obviously you get to keep the fees of those transactions.
But so the block that you're given is randomly assigned, but then the ones you do first.
No. It doesn't quite work like that. Basically, you're allowed to assemble a block. So let's say you have 1 million miners out there. Each of them is assembling a block, and then one of them is elected to allow their block to be published. Right? So whenever someone is, I don't know that I'm going to be elected. My odds are actually very low that I'll be elected because there's so many other miners and it's at random, right? But my incentive is, in case I am elected, my block, I should try and pack it with the highest transaction fee transactions I can find. Because in the case that I am elected, I will keep those transaction fees. Right? So again, this idea of what's the equilibrium? Well, if we assume all the miners are small, again, because there's many small miners, each individually with little market power, there's an equilibrium that they're only going to allow valid transactions. Right? If I'm a miner and I'm elected to sort of produce the next block, I'm not going to allow any invalid transactions. Let's say someone's spending money they don't have. Why? Because if I do, other miners who verify my work will see that. They won't accept my block. If they don't accept my block, I don't keep the block rewards. Right? So this idea of having many small miners, each of them, if you're elected to produce the next block, you really want everyone to accept that block, because if they do accept that block, you get a bunch of money, and so therefore you're going to play by the rules. Right? So there's an equilibrium to only allow valid transactions. And also another thing to, and again, so if you have many miners, the system is going to be secure. Cheating by any particular miner will not occur, because many people will detect that. And in some sense, the proxy for how secure the overall system is how many miners there are. Right? Another thing to observe, how fast things get processed does not depend on the number of miners. Right? Bitcoin is set up so that each block is at most 1 megabyte, again, typically 2,000 transactions, and they occur on average every 10 minutes, and it's calibrated so that no matter how many people are checking it, that sort of stays constant. This is going to be something that's important. So that's the idea of a blockchain. So, again, users decide how much they offer as transaction fees. In fact, you can even offer 0. The small miners are price takers, right? They can't say, I'm not going to process, transactions unless they have a fee above X, because no miner has any power. They don't know that they're going to be selected, right? Yeah, they can't block transactions or affect user behavior. Anyone can be a miner. So in economics language, free entry and exit. And so therefore, you should expect, on average, in the long run, there should be 0 profits to mining. Right? Why? If mining was a very profitable activity, right, people would sign up to become miners. There's no barrier to entry. You don't have to pass a test or whatever. You just have to buy a bunch of computers and set up a data center. Right? So in the long run, we expect a 0 profit for miners. As I argued, the infrastructure level, the number of miners determines the security. But this 0 profit condition, that's going to determine the number of miners. In other words, the transaction fee revenue that's generated, that's going to generate a certain amount of revenue, right? The number of miners will equilibrate until the total mining cost equals that revenue. And so therefore, via that one step of indirection, the transaction fees will determine number of miners and then ultimately the security level. Right, so users decide how much to pay, right? That money flows to the miners and ultimately determines how many miners there are and determines overall the level of security. Yes?
So if you go to 0 profits for miners and you stop minting new coins, what's the incentive for the system to work?
Well, so if you stop minting new coins, there will still be transaction fees. So as long as there are transaction fees, there will be miners. But let me flip your question on its head. Why are the users going to pay transaction fees? Right? Well, they'll pay transaction fees to cut the line. Right? Again, recall that a miner is assembling a block of at most 2,000 transactions. Which transactions are they going to pick? They're going to pick the transactions with the highest fees. Right? So if there's 10,000 transactions already sitting there waiting to be processed, and I'm in a big hurry, right, and I want my transaction to be processed next, I'm going to offer up a big fee, right, to try and cut that line and get my transaction into the next block, right? The flip side of that, for example, if I show up and I know the next block can hold up to 2,000 transactions, but there's only 500 transactions sitting there, I won't pay anything, or I'll pay a penny or something like that. I'm going to be processed quickly anyway, and so why should I pay? I have no incentive. Right? And so, users are paying transaction fees for faster service, but a necessary condition for that is that there actually be congestion. And we have an economic model that quantifies this, right? And illustrates first and foremost, that there's actually a sharp relationship between the congestion and the fees. That there has to be some minimal level of congestion, let's say about 70 to 80%. If there's not the system isn't 70 to 80% utilized, no one will pay anything. Right? Above 70 to 80% utilization, all of a sudden the transaction fees will explode and they will be very unstable. Right? Small differences in the overall utilization will lead to a big difference in the transaction fees. And you can, the great thing is you can see this in the data. Right? So this is data from 2011 to 2017. Each of these points is 1 day. What I've done for each of those days is over the course of that day, on the x-axis is the average block size, right? So again, blocks can be up to 1 megabyte, right? But they won't necessarily be a megabyte. In particular, if there's not enough transactions, they'll be lower than a megabyte, right? And so the average block size, the percentage of that 1 megabyte is a proxy for how congested the system is. And on the y-axis are the average transaction fees per block. And what you can see is for the majority, let's say maybe up to beginning of 2016 or whatever, Bitcoin wasn't utilized relative to its capacity, and basically no one was paying anything. And what happens is once it gets to 70 to 80%, all of a sudden the transaction fees explode, and also small differences in the number of people using it makes for wild differences in how much it costs. Yes?
Is there a reason you use a US dollar transaction fee, given that it's obviously the value of Bitcoin is highly fluctuating.
Good, so
yeah, just wondering why it's not in
So
Bitcoin yet.
I picked US dollars because I'm assuming that the expenses, miners care about how much money they make relative to what they pay, and they pay for things like electricity and computers and so on. Those are typically denominated in fiat currency, so let's say dollars, right? So here, the transaction fees, this is telling me that like, let's say $10,000 per block, I don't know how much that is a day, like, I don't know, I'm gonna make up a number, I can't do the math quickly. Let's say it's $10 million a day, right? That's telling me that $10 million a day is being spent on mining, and so that's a proxy for security, but in dollars,
Okay.
right? Okay, so kind of the key insight from our model is if there are no delays, and indeed if there are no significant delays, then in fact there will be no revenue. Right? So when we think about Bitcoin for the long term, there's been a lot of people complaining that since Bitcoin has become popular, it's become sort of slow and it's expensive. I think at its peak it was costing $50 to $60 for transaction fees to do a single transaction, right? We're saying, well, if the system is popular and congested, that will generate a lot of transaction fees, and that will be a lot of mining activity. So you'll have a lot of security, maybe even too much. Right? On the other hand, if the system is not congested, there will be little or no mining activity, and miners will quit and security will drop and the system will collapse. So in the long run, it's sort of one of these two outcomes. To the extent that Bitcoin becomes a self-funding system where there are lots of miners making sure the system is secure, well, somebody has to pay for all that. The miners aren't doing it for fun, right? And people will only be willing to pay for that if Bitcoin is actually slow, right? And indeed, there are implications for scaling. A lot of people complain that Bitcoin is too slow. Let's increase the capacity. Let's make the block size bigger, or sort of something like that. Well, if you do that, the revenue will collapse. Right? And in the long run, again, to the extent that Bitcoin exists, it necessarily has to have delays and transaction fees, right? So this I thought was a funny article I read a little, a month ago. There was a conference in Miami on Bitcoin, and if anybody's going to accept Bitcoin as a payment for a registration fee, it's going to be a Bitcoin conference. But they actually stopped accepting Bitcoin, and they pointed out to sort of congestion. Right, it takes too long to get the payments, and the fees are high, and so on. Well, I claim that's actually a feature, not a bug. Right, if Bitcoin was not congested, nobody would pay for it, and there would be no miners, and it would collapse. Yes.
Do you think it's possible that sometime in the future there will be like some sort of collusion between miners? So, like, say there will be companies that are hiring people that are professional miners, and they could be somehow big enough to have a say on the price of
yeah, so that actually happens now too, right? It's really not that there's a bunch of small independent miners, but there are these mining pools, and some of them have a lot of power. Like, there might be, a mining pool that has 30, 40% of the total mining capacity. So that's something that is already happening. I'm personally not worried about that, because even if a miner has the ability to sort of manipulate Bitcoin, miners get paid in Bitcoin. And to the extent they manipulate it and someone finds out about it, the price of Bitcoin will collapse. So even if miners end up having a lot of capacity, they have other incentives not to break the rules in that they own a lot of Bitcoin. And they would like Bitcoin to sort of be popular. And if they cheat, the price of Bitcoin will collapse and will really hurt them.
It's a question there of less about the miners' incentive, though, than at one point there were about 53 or 54% in China. 4 conglomerates made up about 54%, which is where you get into that issue of being able to sort of destroy the security of Bitcoin. So again, the question may be less about the miners than an external force acting on a conglomerate. Like, for example, the government of China threatening the miners that are part of the conglomerate to do something, as a possibility.
That's a possibility.
That's where you get, it's maybe less an individual miners or a conglomerate's choice than is there an external pressure on them.
I think that's a possibility. But one thing, in terms of the miners themselves, one thing I've heard, there's been various times where mining conglomerates have gotten close to 50% and they backed off because it's also about confidence in the system. So I've gone over time. I'm just going to quickly sort of wrap up. Again, I think there's tremendous innovation here technologically and economically. Like the first point, before we even go into all the sort of the downsides, it's kind of amazing this can be done. It's kind of amazing that large balances can be, hundreds of millions of dollars in some cases can be held and transmitted between people without any kind of legal system or without anything like that. So it's amazing that it can be done, but what we'd like to do is understand the economics of it, and the key to understanding that is that the economics are driven by congestion. Right, and again, to the extent that the current Bitcoin model is successful in the long term, it will always be congested. Right, that's sort of a fundamental to it. But I think the interesting question, sort of going forward, is to think about how to sort of change that. Can we come up with better systems? Right, so for example, right now the block size is quite large. That actually exacerbates these things. Right? Our research suggests that kind of smaller block sizes are better. But we might also think about other kinds of rules. What other kinds of rules can we use at the protocol level in order to generate revenue for sort of future cryptocurrencies that won't suffer this problem of needing a lot of delay as part of their revenue model? So I'll stop there. Yes?
As someone who's thinking about trading, doing a Bitcoin transaction, do you know the information in the mempool in terms of setting the fee that you would put into your contract?
Yeah, so there's a bunch of websites you can go to where people will say, here's how many transactions are in the mempool. And they will also, and here's what those other people are offering. And they will also give you estimates like, look, if you want your thing to be in the next 6 blocks, which is, let's say, an hour, here's how much you need to bid. If you want it to clear in the next day, you can bid less, here's how much you need to bid, and so on. So there are people who build models for that, and you can find them.
Because Bitcoin's a perfectly transparent.
That's right.
The information and data within the Bitcoin blockchain is perfectly transparent. So yeah, all of that is part of the public record. Yeah.
Yeah.
Correct. The maximum Bitcoin will be what, 21 million?
Something like that, yeah.
All right, and every block, with the 210,000 blocks, the reward is cut in half. Is that correct on the miners?
It's a certain number of blocks. It's on average every 4 years, but sure.
So here's also the cost is quite high as far as electricity and the hardware, which has to be developed and improved over time.
Right.
So the cost is going up, the reward is going down. Do you think there'll be a time when there will be no incentive to try to reach that $21 million maximum size of Bitcoins?
What I think is the costs will calibrate to what the reward is, right? So the number of Bitcoin, the reward is going down over time, but the price of Bitcoin may be going up. Also, the transaction fees may be going up. Again, my model is oriented mainly about looking at the transaction fees, right? So Bitcoin remains popular, and the vision when Bitcoin was developed was that, look, we're going to bootstrap the system by minting new coins, but that's inflationary, so we're going to stop that after a while, and then the system should be self-sustaining based on transaction fees, right? And what I'm saying here is that will only be the case if the system is very slow.
Okay.
Yes?
Do you know if the number of transactions that are occurring is increasing faster than like the technology is increasing to like, is there a point where it's going to be more congested because the number of transactions is not increasing as much as the technology is?
So for the most part, minus what's been going on in the past 6 months where they made some modifications, the rate has been fixed. Right, the rate at which transactions are processed. Again, it's on average every 10 minutes you get 2,000 transactions, right? That breaks down to sort of about 3 transactions a second, right? So to the extent that the system gets more congested or not, it's entirely the number of users, more or less users in terms of people who want to pay each other. The capacity for example, for the 7 years that I illustrated in the plot was always fixed. Yes.
So if a competitor that's not blockchain like Venmo is still cheaper as far as the transaction fee, why wouldn't I just use Venmo?
It's a good question. And I think it depends who you are, right? If you are, running a conference or something like that, absolutely people will use Venmo. And again, when Bitcoin sort of first came out, there was a lot of talk that you're going to go to Starbucks, you're going to pay for, your coffee in Bitcoin and so on. No, that's disappeared. Nobody thinks that anymore because it's so expensive, right? Now, maybe a good question is why would anybody pay this given that there are alternatives? Well, depending on who you are, you may or may not have those alternatives, right? So, for example, we have lots of alternatives to pay each other. But I don't know. Let's say you're in China and there are capital controls and you're trying to move your currency overseas. Maybe there's no, maybe you can't use a wire transfer. You can't use Venmo. You might not have alternatives, right? Or in the sort of extra legal domain, if you're paying a ransom, if you're buying illegal drugs on the dark web, so on. All those people don't have options. And so if your option is I can either pay you with Bitcoin or we can meet in a dark parking lot and I give you a big suitcase full of cash, maybe Bitcoin is better than that. Right, but certainly for let's say payments within the United States, I don't think anybody uses Bitcoin strictly as a payment mechanism.
Okay, so they are marketing larger institutions.
I think the appeal is for either people who don't have access to the centralized payment systems, like can't use FedWire or Venmo or whatever, or people who want to operate outside the legal system. Right, you're doing something illegal, then you can't go to the bank and wire money to pay for it, right? So I think that's what's driving the. Those seem to me the only people who would economically, rationally pay $50 for like a transaction fee, as opposed to go to Bank of America and send an ACH for free or something like that. Yes.
I would just say I would also add there's a little of like a Wikipedia incentive, which is just. I believe the belief in the trust value system is something I want to support, even if it costs me more money. In the same way, I'll buy a Gucci bag instead of a Coach bag. Maybe perfect craftsmanship, they may be the same, but Gucci is is a premium, is a luxury brand. Some of it is using Bitcoin potentially because I believe in a non-government entity system to exchange.
Let's say non-economic considerations, right? But if you trade off like the service quality, like how fast is the payment and how much it costs and so on, there's no way that Bitcoin is a good payment system. Yes?
So, obviously the benefits of Bitcoin or any of these blockchains, the decentralization, so as great as it is to be able to use a Venmo, even if I'm in America, I may want to have a system outside of that centralized trust mechanism. So are there any blockchains that you looked into that have an alternative method that you feel more comfortable about, low transaction fee, payment option?
So there are a bunch of systems where you don't have free entry and exit of miners, and the miners are vetted and trusted. Right, so I'm thinking of things like Ripple and Stellar and things like that. Those systems tend to be high capacity and very fast, right? But one would argue, that certainly the decentralization purists would argue that those are centralized systems, right? So a company like Ripple is going to obey by the laws of the Federal Reserve and United States and so on and so forth, right? So there, it's there's a blockchain involved, but it's kind of centralized. One company is running it, right? If you have a truly decentralized system where anybody can sort of enter and exit as a miner, the examples I've seen tend to be sort of Bitcoin-like in that they rely on congestion.
And what about the long-term posits around, I'm not thinking on the Bitcoin blockchain, but on Ethereum with sharding or... Ethereum
has the same issue, right? Ethereum also operates on this. It's just less of an issue with Ethereum because Ethereum doesn't have as much congestion. Right, but Ethereum has the same issue. Now there might be technological ideas that ameliorate that. There might be sort of a better way, and I think those are interesting design questions sort of going forward, right? But currently the decentralized payment mechanisms that I see all rely on congestion. Yes.
What's the significance of Bitcoin's 21 million coin cap, or Litecoin is around 80 million? Why that number? And what does it mean for the system that it has a cap on the number of coins?
So this is sort of more kind of monetary economics question that I'm sort of not equipped to answer. But I think the feeling is that again, there's a sort of libertarian ethos that pervades Bitcoin is that you can't be printing more money. That's inflationary. It devalues existing money. So if we really want Bitcoin to be sort of a store of value, it should be like gold. There's a finite amount of gold on the planet. Period. Right. So Bitcoin should be like that. Now is that like a legitimate economic argument? Who knows? Right? Actually, one way I think to look at this research is actually that this congestion idea maybe isn't a good idea, and maybe we should continue these block rewards forever, right? Because at least that you can sort of pay for the system in a way that doesn't require the system to be slow. Yeah.
So you said that, so every 10 minutes there is a new block,
Yes, on average.
on average, and there's one miner who gets assigned to make that block,
That's right.
and it's all random. And what's-
Approximately, yeah.
And what's the incentive for them to invest in better equipment and larger capacity? Like, I thought they were supposed to, like, be solving.
Okay, so let's say once every 10 minutes someone is going to give out $10,000, right? And let's say your chance of winning that $10,000 is 1 in 10,000, right? Then you should invest $1 in order to participate in that, right? Because the expected value is $1, so that's why. So there's a low probability of being picked, but if you get picked, you get a lot of money, right? So in equilibrium, people do that expected value calculation. The miners are actually really, really rational. They really carefully track the profitability of mining different coins, and they might switch from mining Bitcoin to Bitcoin Classic or mining Ethereum or whatever. But it's all based on what they perceive as how much money will I get in terms of if I'm elected to do the next block, times what's the probability that I will be the guy who does the next block.
So do they actually just operate a bunch of computers at the same time, or is
Yeah.
it like a huge computer?
No, it's a bunch of small computers.
Okay.
You mentioned earlier about verifying transactions by being able to go back in history to see exactly what the Bitcoin holdings of that member has been.
That's right.
So doesn't this raise issues about privacy?
Yeah, and so Bitcoin is not an anonymous system. It's what I'd call a pseudoanonymous system, right? So if you go back all the way to the beginning of Bitcoin, you can see every transaction. And so you will see which accounts paid and which accounts received. Now, you can't put this down to a person, right? This is just sort of a series of numbers. But if sometime later, like let's say I seize your computer and I figure out what your account numbers are, then I can see your entire transaction history.
But you could also, like, if this becomes more mainstream and you know that, okay, a sovereign wealth fund of an Asian country has been doing so for the last year, you can start to kind of unravel who that person is based on
Perhaps.
actions. And even if you don't know the identity, you could still predict what that person is going to do based on what he's done.
And I think people try to do that. So I think I've heard there's a lot of people who trade Bitcoin watch the blockchain carefully, because you can see if someone transmits a bunch of Bitcoin to an exchange, maybe they're going to sell that Bitcoin, right? And that's going to exert downward pressure. So if I see someone send the Bitcoin from whatever address to an exchange address, maybe I should sell Bitcoin. So you're absolutely right. And there are other crypto systems that have emerged since Bitcoin where people make more of an effort to anonymize things. But you're right, at least at the level of account numbers, all transactions throughout all time can be tracked.
So since the revenue depends on the congestion, could you like artificially create more congestion? And say like processing every 20 minutes rather than 10 minutes?
Yeah, so that's kind of one of the things we've been thinking about. Either manipulating the time between blocks or manipulating the length of a block in order, like, let's say, you decide that the amount of security I want revenues of $100 million a year. That's a security I want, right? Rather than like, in the current system, it's hard to target something like that. But if you targeted the amount of time between blocks, you could create just enough congestion to generate $100 million in a way that doesn't inconvenience people any more than necessary. So I think that's an interesting research direction.
And that you're kind of bringing up, like the rules have changed. There is a proxy of the people in the system that adjust.
But they haven't changed dramatically.
They haven't changed dramatically, but like you used to be able to trade a Satoshi, right? And then they increased the minimum amount of Bitcoin that you could trade became a new rule of the system, for example. So again, for all of it's there is a democratic process involved in some of the rules underpinning the cryptocurrencies as well by the participants in the system about changing the rules at times.
Mm-hmm. Maybe one more question?
Yeah, I was just wondering who or what makes the decision to choose a certain miner to get a block from it?
It's random, and the specific mechanism is it's kind of like a contest. So you can sort of think of it like this. The Bitcoin system keeps track of how many miners there are. And based on how many miners there are, it calibrates a mathematical problem so that on average, one of those miners will solve that mathematical problem every 10 minutes. And the mathematical problem is akin to kind of, let's say, tossing coin. Let's say for you to be elected the next guy, you have to toss a coin 100 times and it has to come up heads 100 times. And there's a way for you to prove to me that you did that, right? And then exact number, whether you should get 100 or 101 or so on, it'll be calibrated based on the number of people like you so that on average it's every 10 minutes. That's what they call proof of work. Okay, so just maybe in the interest of time, I'll stop here.